our position has consistently been that the virus matters, whether the wider investing world thought so or not. Obviously, we've had a massive resurgence since the 23rd of March, but it's one that we've been cautious on, and one that we've been somewhat circumspect about, given the fact that, as we knew, markets seem to have been pricing in a perfect dismount from the most complex maneuver that we've ever had to manage in markets. And clearly, there's been some revisiting of that optimism, which is probably fair. Look, nothing goes up in a straight line.
I mean, the president's saying there will be no new lockdown, and I don't hear an appetite for that anywhere else. So I guess we will just continue to have to live with this. To what extent does it suppress demand, do you think?
In a major way. So, I mean, obviously, if you think about over the years that I've been on your show, I would have usually gotten into a taxi and I would have come to your studios. Now, we're still carrying on with the show, but obviously I'm doing it from home, and that bit of spending that would have occurred on the taxi is gone. That's a good paradigm for really how we're going to be moving forward, which is essentially a depressed consumption function across the board. Because we're just going to have a social prudence paradigm that basically is here to stay on one level. And on the other level, we've also got the fact that, if you look at the closest historical proxy we have to the huge hit, what the IMF economist was just saying earlier, is 1929. And if you see the 1930s, there was a permanent frugality that settled over markets. And both of those things are a big reason why we consider that the future growth path is going to be very depressed.
Trouble is, and you know this as well as I do, and we've been discussing it for years now, Fahad, that what are your alternatives here? You can put it in a deposit account, you can give it to the bond market, but bonds may ultimately have to pay for this crisis. That leaves you with equities ultimately. So even as I think everybody understands your reticence about the pricing of equities at the moment, have you got any other choice?
Well, look, the TINA factor has been, as you're right, we've been discussing it for years. It's been a powerful driver of equity market performance since 2009, and that remains, all the more powerful today. However, let's not forget that, getting essentially zero return in cash or essentially zero return in bonds is a lot better than a worst case scenario in equities, which could see a -30, -40, -50% fall. That's, one enormous factor to continue to be a little bit cautious, right? Equities undoubtedly are the only game in town if you are a long-term investor. But at the same time, you don't want to suffer a strong drawdown in the short term, which is why you've got to be careful about when you add, how you add, and exactly how long your time horizon and your appetite for risk is.
It seems like a good point then to ask you, what advice are you giving your own clients about where they allocate to at the moment?
Well, it's a great question, and obviously each client is different, and circumstances will depend. But we are cautious still. We are underweight equities, and we have been really since this pandemic began. We are obviously looking to add back to equities some time because, as you said, there is very little alternative. But we are not going to do so until our process guides us to do that. We want to see a shift in the second derivative for economic growth. We want to see earnings at least start to shift in the same direction, which they're not. We also want to see momentum in global equities be sustained in a positive trajectory. So far, on the 200-day moving average, they've just nibbled around the edges. But if that breaks through into the positive side and that's sustained, we'll look to add back to risk on these three factors. But we haven't seen a sustained move in any of those three factors, which is why we've remained cautious.